it's been, as an investor, a roller coaster of a year. Obviously, we're at the highs, certainly in the Dow Jones and the small cap Russell 2000. It's now really a time to be patient. You want to take a look at your portfolio. You want to make sure that you are not overexposed to growth, technology, FANG, because we do think that that is likely a story that is going to continue its underperformance of recent weeks into 2021, and that you are diversified. But again, given how far we've come and given the challenges directly in front of us with regard to the economy and the potential for further restrictions, now's the time to be patient.
Okay, but let's talk a little bit about what it means to be patient. I mean, for a lot of people, the big decision this year, possibly a big discussion point, was back in the spring when they were asking themselves, I know we did in my house, like, in terms of the 401k, should we get out of the market? And there was a sense of, you know what, we're at the lows, market timing is always problematic. There's a reason to stay broadly invested. And so I think now is the time that those follow-up discussions are happening around, okay, well, have we come too far too fast? And what about all this enthusiasm about the roaring 20s? I mean, you're not saying that you're cautious on the stock market, overall, or maybe you are. I mean, is this just about, for those who want to get more tactical about it, ways to be more tactical?
Right. So if you go back to the beginning of 2018, Kelly, we've had a number of these roller coaster events. The fourth quarter of 2018, obviously February and March of this year. But the long-term trend has remained higher. We think it remains higher. But when you get as overbought as we are becoming right now, what you have to say to yourself as an investor is, how am I going to feel if I experience a 10 or 15% drop in the market? And what if you go back over the course of really the long term, is that you want to be able to envision yourself as a buyer down 10 to 15%, not, sort of panic cutting your holdings. So if you can't see that, then you either, trim some of your holdings. Cash is always an option. Or, we kind of think that given the fact that volatility is at the pandemic lows, downside hedges in technology triple Qs, as well as hedges in small cap stocks, the IWM, which has run a really long way, also makes sense.
Shepard Smith here. Thanks for watching CNBC on YouTube.